Elsewhere, European stocks continue to fall 1 week after those parliamentary elections shifted the EU further to the right. Today, Citi downgraded Europe to neutral while upgrading the U.S., in part due to heightened political risks overseas. Joining me now, the strategist behind that call, Beata Manthey. She's head of European equity strategy at Citi Research. Beata, welcome.
Hello, Kelly. Thank you for having me.
It might be reassuring to some of us to hear that you think Europe's political risk is bigger than ours right now. Explain.
Exactly. This is the pushback I'm getting, that we are talking about geopolitical risk, political risks in Europe. And the biggest risk actually is coming out of the US. But we have this framework in place that captures geopolitical risk premium out there in the markets. And Europe within the developed markets tends to be the most exposed. So even if the center of the problem, if you assume sitting where you are, that it is the US, not Europe, actually the problems seem pretty big here, over here in Europe as well. It's still these more cyclical markets like Europe that are more exposed in a negative way.
Peter Bukvar put it perfectly this morning and captures how I feel about Europe as well. He said ever since the Mario Draghi moment, when the head of the ECB about a decade ago just came out and said, we'll do whatever it takes to defend the euro, and the European crisis just went away, leaves me feeling like, well, I guess Christine Lagarde can just clean up whatever mess is made, and we don't really have to worry too much about these developments. What would you say?
So there are two issues about the central bank rates and Europe. Short-term issue is probably it's in the price, but the long-term issue is, I would argue, it's an upgrade for the European equities or cyclical equities around the world. Because the environment we've seen after whatever it takes, or after the GFC, was the environment of zero rates and zero inflation. That's an impossible environment for cyclical markets to outperform a growthy market like the US. So the emergence of inflation and the fact that even after the cuts that we have penciled in, we have another 2 for this year, another 4 for next year, the terminal rate is still going to be substantially higher than what we've seen over the past decade. And that's an upgrade for cyclicality. So don't forget about Europe yet. What is happening in the political front is short-term headwinds. Another headwind I would point out also is what you've just discussed at the previous panel, and that's the narrowing risks of market narrowing again into mega cap, large cap growth. And when that happens, that's the environment where the US tends to outperform. For Europe, more conducive environment is broadening, which we think, given the developments in the European front, and ECB has a lot to do with it. So we have the early cycle environment, improvements on the economic side, improvements on the EPS side. If that continues, we come back to broadening later in the year. But for now, the risk is it narrows.
So if you reason to downgrade number one are political risks, you say number two, narrowing markets, like you just explained, and number three, it's just a positioning unwind because there was kind of this over positioning on Europe heading into some of the recent volatility. I mean, what would it take to make Europe a growth stock again, a growth market like the U.S.? Is it possible?
It is complicated, right? Europe is a cyclical market. Growth per se, the amount of growth in the composition of the market is only 15%. For the US, it's 50%. Wow. But cyclicality is 50%, and a lot of it is in banks. So we need rates staying higher, and we need the broader economic growth or improvements for Europe to start doing well again.
All right. And no matter what happens with the politics in the near term, Beata, thank you for joining us to discuss. We really appreciate your time.